Buying long or selling short. A stock price will do one of three things over time. It will go up, go down, or move sideways. As a swing trader, if you take a position in a stock, you are expecting it to either go up or down. If a swing trader expects the stock will go up in price, they will buy the stock. This is referred to as going long or having a long position in a stock. Being long 100 shares of Facebook Inc. FB means that you have bought 100 shares of Facebook and are expecting to sell them later at a higher price for a profit. Obviously, going long is what you do when you expect the price to go higher. This also means you are bullish on Facebook stock. Bulls expect prices to rise. What if you believe that the price of a stock is about to go lower? In this situation, you can borrow shares and sell them with the expectation that you will buy them back at a lower price and make a profit. But how is it possible to sell shares that you do not own or hold in your account? Simple. Brokerages have a mechanism that allows traders to borrow shares. Selling shares that you do not actually own is referred to as going short or being short a stock. When traders say, "I am short IBM," it means they have borrowed shares from their broker and sold them with the expectation that the price of IBM will drop and they will be able to replace those shares by purchasing them later at a lower price. It is the same old adage of buy low and sell high, you're just doing it in reverse. You are selling high and buying low. An investor who shorts IBM is bearish on that stock. Bears expect prices to fall. When you set up your account to trade, you will likely need to fill out additional forms with your broker that will allow you to take a short position in a stock. You should understand that shorting a stock could be riskier compared to purchasing or going long on a stock, so you need to actively manage your position. Simply put, when you go long on a stock, the absolute worst thing that could happen is the company goes bankrupt and you lose all of your original investment. If you go short on a stock and the price starts to rise, your losses can be much higher than your original investment because there is no limit to how high in price it can go. Let's look at an example from a company called Longfin Corp, LFIN. Imagine you think the stock is overvalued at $5, so you decide to short 500 shares and then go about your other daily duties without monitoring the position or setting up a stop. I will discuss stops later. The next day you check your position and see that LFIN is now trading at $20. The 500 shares you sold for $2,500 now will cost you $10,000 to replace. If you decided to hold, thinking it could not go any higher, things got a lot worse with the stock heading to a high of $140 per share. Replacing the 500 shares that you borrowed at that price would have cost you $70,000. This example is illustrated in figure 2.1 below the chart of LFIN. Obviously, this is an extreme example and most smart traders would not have let this trade go so wrong. However, the example does illustrate an important concept about shorting stocks and the need to manage your position, especially when going short. You can lose a lot more than your original investment. Figure 2.1, a chart of LFIN going up like a rocket and illustrating how being short can be much more risky, chart courtesy of stockcharts.com. Short selling is an important tool for a swing trader because stock prices usually drop much more quickly than they go up. It is a commonly held rule of thumb that stocks fall 3 times faster than they rise. The explanation for this lies in the human psyche. The fear of loss is much more powerful than the desire for gain. When a stock starts to move lower, shareholders fear they will give up their profits or gains and they quickly sell. This selling activity feeds into more selling as shareholders continue to take profits and traders start shorting. The additional shorting activity adds to the downward pressure on price. The stock price goes into a strong decline, which means short sellers can make very good profits, while other long traders and investors go into panic mode and dump their shares on the decline. The following is an old stock market adage with the bull-bear terminology.